Welcome to the InterMarket Analysis video update. This is a video where I take a look outside of the S&P 500 and the stock market to see how other markets are interacting with the stock market in general and the S&P 500 in particular. This is being prepared for Monday, February 6th. The first thing we look at is valuation. This is a chart going all the way back to 1990, and it shows three colored lines. We have a red line that's dashed. That represents a PE ratio of 20. When we're at that level or above, the market is considered to be expensive. The blue line represents a PE ratio of 15. When we're at or around that level, the market is considered to be fairly valued. The other dashed line is a green line, and that represents a PE ratio of 10. When we're around that line or below that line, the market is considered to be inexpensive or cheap. Looking at this chart, you can see that we are still above the PE ratio of 20. Now, this chart looks backwards. We look at the trailing 12 months. The stock market doesn't use that. They use forward-looking PE ratios, but this chart can still be helpful for us to see on a historical basis, are we fairly priced, are we expensive, or are we inexpensive? Right now, we are expensive with the S&P going above 20. This chart down below takes the value of the red dashed line and the S&P and computes them together. When we're above this zero line, that means the S&P is expensive. When we get down below it, the market is coming back in line. Currently, we're expensive on a trailing 12-month basis. This is the same chart, just going all the way back to 1980, showing different events that have happened and how the valuations changed during that time. The market spends a lot of time being either near overvalued or overvalued. Right now is not an exception. It's very common for the market, which is forward-looking, to project higher earnings into the future, and this builds a lot on the optimism of the stock market. Another thing that we look at is growth versus value. This is a pure growth index where it shows that it's still in an overall downtrend. We're getting close. If we can see growth break out here, we might get a golden cross where the 50-period moving average moves above the 200-day moving average, but it hasn't happened yet. Another area that we look at is value. Right now, this is in an uptrend where we're above both of the moving averages and we continue to go higher. We look at a ratio between the two, growth versus value on the top, showing how growth is underperformed. On the bottom, this is value versus growth, showing that how it has outperformed for most of 2022. Another way to look at this is a pure growth index divided by a pure value index, and then taking that ratio, showing that growth has really been underperforming value and continues to fall, even though the market has been going up lately. This is an inverse of that same chart, showing how value has really been outperforming growth. This is another look, the S&P 500 growth ETF against the S&P 500 value ETF, showing again how growth has been really underperforming. This is an inverse of that same chart, showing through 2022 that value has been outperforming growth. Another way to look at this is by looking at indexes, showing how growth has been underperforming value. I look at ETFs, indexes, and a lot of different things because sometimes they give us some insight when we look at variations of the same thing. Some other markets that we keep track of are the dynamic software companies. These are the 30 biggest U.S. software companies. They're showing a lot of improvement as of late, but we're not there yet to get a golden cross. The CRB monthly, which is still going up but seeing some recent weakness, that's on the top, where here we have an inflation by deflation ratio on a monthly chart, showing how inflation has been picking up lately, but we're still below this moving average. The Baltic Dry Index is another look at inflation. When this is going up, that means it costs more to ship goods from point A to point B. When it's going down, that means the shipping prices are lower. The CRB Index, which is where we get a lot of our inflation information, when this is going up, commodities are going up, and sometimes that bleeds through into inflation. Well, we've seen a death cross recently, and the CRB Index continues to decline. Corn, I don't have any studies on these upcoming charts here. We're just looking at them to see what their current prices are. But corn had really spiked up. It came down, and now it's been settling around the 677.5 level. Aluminum, I do have a couple of moving averages here. It still is in an overall downtrend, but has been bouncing up, and we could see a golden cross on this chart soon. Heating oil, after going up really high, has been coming back down, but it's still at higher levels when compared to where we've been historically. Gas is really starting to come back down after it had been going up in early January. Natural gas, after spiking up at 10, is now dropped down to 2.41. Oil is also dropping lately. It's down below 75 at 73.39. Diesel, it's been settling around the 4.62 level. This is what is needed to transport goods using trains or 18-wheelers. When this goes up, it costs a lot more to ship things around the country. To help keep prices down, we want to see this price come down as well. Wheat, after really spiking up, has been coming down lately. Fertilizer, we want to keep an eye on those prices. After really spiking up, has been declining and is still kind of at a high level when you look back historically. Lumber, which had been in a really solid downtrend, has now been bouncing back up and is looking more positive. The dollar, which had been strong about halfway through 2021 and into 2022, topped out at about 114 and has been coming back down only to give us a recent death cross. The euro against the dollar. The euro's been going up as the dollar's been going down. This chart looks at the Japanese yen, which has also been going up against the dollar as the euro goes up, but the dollar is continuing to go lower. The British pound just gave us a recent golden cross and has been climbing against the dollar. The Japanese yen, the same thing. Copper, after really spiking up and giving us a golden cross, has been falling back lately. And we look at copper because it's called Dr. Copper. What is the economy going to look like in the future? When copper is going up, that tends to bode well for the economy. When copper is going down, that tends to be more negative for the economy. The copper to gold ratio is another thing we watch. Copper had been breaking out but showing some weakness, but then we're seeing a little bit of a bounce back lately. This is a longer term look at that same chart showing how copper has been outperforming gold for the most part, and then we compare this to the 2-year yield. These tend to get not very far apart from each other, and they also have a tendency to go in the same direction. They haven't been doing this for a lot of 22 and now into 2023. Gold gave us a recent golden cross and is in an uptrend, but saw some real weakness in Friday's session. The same thing with silver, also in an uptrend, but real weakness on Friday. Looking at some indexes, the CRB to the S&P 500 shows that the CRB is now continuing to underperform the S&P 500. This shows where the S&P 500 is starting to outperform the CRB index. The Nasdaq 100 continues to underperform the S&P 500, but we're seeing a lot of strength since the beginning of the year, but not enough to give us a golden cross. The S&P 500 against other stocks, here's the mega cap growth ETF. These are the real big companies, Apple, Microsoft, Google. We've been seeing some recent strength here, but not enough yet to give us a golden cross. Here's a relatively new chart where on the top we have the S&P 500, and then down below we have the mega cap growth, the chart that we just looked at, in a ratio with the S&P 500 equal weight ratio. Now, the S&P 500 is a weighted index. The bigger companies will move the index more. The equal weight index is exactly like its name says. Every stock counts the same, and sometimes we can get some useful information from that. It's still showing how mega cap has been underperforming the equal weight index, but seeing some recent strength. The NYSE bullish percent index. We follow the bullish percent index very closely on the daily charts and even the weekly charts. That is as it applies to the S&P 500. To get a broader measure, we look at the NYSE bullish percent index, and it is starting to break out from the highs set back in the summer. The S&P 100 continues to underperform the S&P 500, but seeing some recent strength. The small caps continue to outperform the S&P 500, and they're in an overall uptrend, and that can be really positive for the market. The low volatility ETF, this is what people get into when we're having trouble in the stock market. We've been bouncing around a lot in 2022. We just generated a recent golden cross, but prices are really going sideways for the most part. And then to compare the low volatility ETF with the S&P 500 in a recent uptrend, but seeing some weakness as of late. The Dow Jones Composite Average, which takes the Dow, the transports, and the utilities together, they just gave a golden cross in late December and are in an overall uptrend. Looking at Dow theory, we really just look for any kind of divergences here, where we're not seeing a real breakout in the Dow right now. It was weak over this past week because of some earnings report that really dragged down the overall index. The transports were really breaking out, so that's a little bit of a divergence. We'll want to keep an eye on that. And then utilities have been seeing some weaknesses as of late. So we'll want to keep an eye and see what happens with this particular chart. Another approach to Dow theory, thinking that the Dow and the transports are a bit outdated from when they were first created, was Charles Dow who created Dow theory. The Dow at that time, which bears his name, was much different. Today we have much more in the way of service organizations. The transports include things that didn't even exist when Charles Dow was around. And so some people think that maybe the S&P 500 is a better measure, comparing that with the NASDAQ. Looking at this chart, we see a negative divergence right at the end of 2021. The S&P was going on to make another high, where the NASDAQ did not confirm that. Well, we're seeing something positive right now. The S&P, it made a low back in October and has been setting a series of higher lows. The NASDAQ, however, set another low right at the end of 2022 and has since been showing some strength. So we could say that this is confirming each other, or we could call this a positive convergence. FANG stocks, which is Facebook, Amazon, Apple, Netflix, Google, and a bunch of other stocks that aren't included in the acronym, they're showing a lot of strength as of late, but not enough to give us a golden cross. ARK also had a good week last week and has been bouncing after hitting just below 30, but not enough yet to generate a golden cross. Here's a chart that I first showed in last week's video. Up on top, this is trying to compare the S&P 500 with stocks that are based in Europe, Australia, Asia, and the Far East. This is a ratio where we look at the S&P 500 compared to the international ETF. When this is going up, that means the S&P 500 is outperforming. Well, we're starting to see some weakness. We're coming right back down to this 48-period moving average, but then bouncing up from there. Another thing we can look at is a thing called the percentage price oscillator, or PPO. That's down below. And when you see other times when we drop down below this line and then turn back up, that can often be very positive for the S&P 500, especially on a ratio basis. We're watching this chart to see if the PPO starts to turn back up. It's still declining, but we'll keep an eye on that. Looking at bonds against stocks, the total bond ETF is just about ready to give us a golden cross. We're seeing bonds enjoy some strength lately. The World Bond Index, not quite ready to give us a golden cross here with the World Bond Index, but if we keep going higher with bond prices, that could bode well for the World Bond Index. The stock-to-bond ratio still shows that stocks are outperforming bonds. Both had a terrible 2022. Stocks, on the other hand, did better than bonds did, and they're still in an overall uptrend. Looking at some shorter maturities, the 7 to the 10 year compared to the S&P 500, not really seeing any kind of a breakout currently. We've got a lot of inverted yield curves right now, and so things that are happening are not necessarily normal. Here's some high yield corporate bonds. This is an ETF showing that we had a recent golden cross and are in an uptrend. And then this is investment grade corporate bonds, also showing a recent golden cross. Looking at the stock to bond ratio, they're having a fairly strong tendency to go in the same direction. So if bonds are up based on price, stocks are up, at least right now. Now this can always switch, and then we'll see this in our correlation chart. The Dow Jones Corporate Bond Index giving us a recent golden cross and now establishing an uptrend. The 10-year Treasury yield, which had spiked up, is now continuing to come down. Here's another look at the 10-year yield. We're currently at about 3.532%. Here's the 30-year yield, which is not much higher than that. It's at 3.63%. Looking at the S&P 500 against the 10-year Treasury yield, it just shows that the S&P 500 has been really underperforming the rise in interest rates. Junk bonds. These are high yield bonds that folks like to get into when they're not really getting anything from government bonds or even corporate bonds. And this tends to follow the stock market. We're seeing a recent golden cross and a new uptrend. This is a ratio between junk bonds and the bond ETF ratio, showing that even when junk bonds were suffering a little bit in 2022, they were still doing much, much better than government bonds. Here's a daily chart looking at the yields for the 30-year, 10-year, 5-year, 2-year, and 3-month. The 3-month is still on top. We have a lot of inverted yield curves, as I stated. The overall tendency has been for interest rates to come down, but on Friday, with the really high employment situation report, we saw interest rates go back up and bond prices go down. Here's a weekly chart looking internationally with the US, the UK, and Germany up here on the top. And then down below is Japan. They're kind of their own little story right now that I'm keeping an eye on. And if that breaks into something big, I will be sure to let you know. Looking at the S&P 500 against some other sectors, this is one we've been keeping a close eye on too. When this chart is going up on the bottom, that tends to lead the S&P 500 higher. The inverse of that is also true. After bouncing around quite a bit, we're starting to see the S&P outperform the utilities sector. Here's the staples sector, things that you have to have no matter what's going on in the economy, giving us a recent golden cross, but really bouncing all around right now, not establishing any kind of significant trend. The energy sector has been really outperforming the rest of the S&P. The tech sector is showing a lot of improvement, and we could be getting close to a golden cross, but we haven't seen that yet. The semiconductors did give us a golden cross and are showing more of an uptrend. This could bode well for the whole technology sector. Here's the tech sector to the S&P, where it's been in a downtrend overall, but we're seeing some strength going back to the beginning of the year. I have a number of new charts to show you just to see if these give you any additional insight. On top is the S&P 500 to the discretionary sector. The S&P 500 has been outperforming discretionary, but lately it's been starting to underperform. The bottom, and I did put a label on here, but it just doesn't save for some reason, shows how we're seeing a comeback with discretionary when compared to the rest of the S&P. Here's another look showing discretionary against the S&P 500. Again, we've been seeing some recent strength. The energy sector, which had been doing really well, is now starting to see some weakness when compared to the rest of the S&P 500. Materials, also doing fairly well, but saw some weakness as of late. The financials also were in an overall uptrend, but showing recent weakness. Real estate has been going up overall. We've seen some real weakness in real estate, and that was more in the fall as this ratio was really going down, but we're starting to see things stabilize and climb again. Utilities that I talked about earlier, this is just showing how utilities are really beginning to underperform the S&P 500 as of the beginning of 2023. Healthcare, also this tends to be more defensive because people need healthcare no matter what's going on in the economy. Had been doing quite well, but since the beginning of 2023 has really been underperforming. Here's another look at that same chart showing how healthcare had really been going up, but showing some recent weakness. Another ratio to look at is the NASDAQ against the S&P 500. The NASDAQ had really been underperforming, but is starting to show some strength. And here's the NASDAQ 100 to the NASDAQ. They're kind of going sideways since they tend to move more or less together. The NASDAQ 100 is the 100 biggest stocks in the NASDAQ. Looking back here in 2019, we really saw that the NASDAQ 100 was outperforming the rest of the NASDAQ. About halfway through 2020, we saw where it started to underperform. It's since come back quite a bit, but then we've been chopping around as the market's trying to figure out what to do. Some other areas that we look at, growth against bonds, both just really got hit in 2022. We're seeing a death cross here, but some recent strength, so growth is starting to outperform bonds. The 10-year Treasury yield against the tech sector. Tech does not like rising interest rates because they borrow a lot of money to put out their new products. Yields had really been rising a lot faster than tech, but we're seeing some recent weakness. This could be getting ready for a death cross. Here's an inverse of that same chart showing how tech had been going down, but showing some improvement. That could give us a golden cross. Discretionary against staples shows how discretionary has really been underperforming staples, but it's been a really hot sector in early 2023. This shows staples against discretionary, just an inverse of that same chart. Staples had been doing quite well, but are starting to come back down, but they're still in an overall uptrend against discretionary. Looking at the energy sector to tech, energy had really done well in 2022. It's starting to show some weakness against tech. Gold, for a while, was looking to really outperform the S&P 500, but has been seeing some weakness lately, but we're still in an overall uptrend with the blue line on top. Gold to the dollar, also really starting to outperform the dollar, but some recent weakness. High leverage loans. If the economy was getting ready to fall off a cliff, do you think this chart would be going up? That's just one thing to look at amongst many. We saw a recent golden cross here with high leverage loans going higher. InterMarket Analysis chart showing how oil, which had been doing much better, is still doing pretty good, but it's down from its highs, followed by the dollar, which is still positive. Gold had turned positive, but seeing some recent weakness. We're seeing improvement with stocks and bonds here, but they're still negative going back to the beginning of 2022. Looking at some different indexes, this takes the Amex, the NASDAQ, and the NYSE together and then looks at a 5-period moving average of the highs minus the lows. When we're above zero, that is more positive. Small caps, recent golden cross in an uptrend, closed just a little bit above R1. Mid caps, recent golden cross, going up to R1, hitting that as resistance and then backing back down. The Dow, which is starting to lag where it had been really leading going back from October through the early part of December. It's pretty much chopping sideways now, but it's hanging in there with an overall uptrend. The diamonds have switched back to neutral. The NASDAQ, which has been in an overall downtrend, is showing some strength, coming up to this R1 level before backing back down, but we're not at a golden cross yet. The same thing is true for the NASDAQ 100. The Qs, which are the ETF based on the NASDAQ 100, they have switched back to neutral after being positive. NYSE Composite, recent golden cross and now establishing an uptrend, and this is another broad-based measure of the market. The Wilshire 5000, just about getting ready to give us a golden cross as long as we stay above both of these moving averages. All stocks, we had a golden cross recently and are establishing an uptrend. We're getting close to an uptrend being established on the weekly chart. Emerging markets, a lot of folks are starting to get into that right now. So we're seeing a golden cross here with this ETF. Internationally, China has now started to decline, as have the other emerging markets, whereas Europe is still in an uptrend. Japan's kind of rolling over right now, and the US is in an uptrend. Bitcoin is still in an overall downtrend, but it's bounced back since the beginning of the year. Looking at some correlations, the S&P 500 to the dollar, neutral right now. Not going in the same direction, not going in opposite directions. S&P to oil having a tendency to go in opposite directions of each other. The S&P 500, the 10-year correlation, also having a tendency to go in opposite directions. Same thing is true with the tech sector to the 10-year yield correlation. Opposite directions right now. The S&P 500 to the 2-year back in neutral land. The home builders, we're looking for divergences or convergences here, where we're seeing a real breakout with the S&P 500. We're also seeing the home builders ETF going up. The ratio is also going higher, and they're having a tendency to go in the same direction. When these get out of line with each other, that's when we really take notice. So what is positive as of Monday, February 6th? Value indexes and ETFs continue to be positive. The euro, the Japanese yen, and the British pound to the US dollar are all positive. Gold and silver, the low volatility ETF, the Dow Jones Composite Average, bonds, both the ETF, high yield and investment grade bonds, as well as corporate bonds, junk bonds, staples, semiconductors, high leverage loans, small caps, mid caps, the Dow, the NYSE Composite, all stocks, and emerging markets. So what is negative? The growth indexes and ETFs continue to be negative, as do the 30 biggest software companies, the CRB index, the dollar, mega cap stocks, FANG, ARK. world bonds, although they're getting very close, the tech sector, the NASDAQ and the NASDAQ 100, the Wilshire 5000, and Bitcoin. Thank you. I hope you found this useful. I am preparing an additional video that goes with the weekly video where I'll break down the Isabel Net charts and try to go into more detail with that. I hope you have a great week, and I'll talk to you in the next video.